Gene Munster, managing partner of Deepwater Asset Management, joins us now. Gene, great to have you with us. I'm not going to ask you about European banks or the banking system, but to the extent that tech stocks managed to rise on this narrative of a Fed pause because of the instability of the banking sector, has any of this changed your view of tech stocks and their ability to make gains this year?
It hasn't. As a reminder of my view, Melissa, I think the first half of the year is still going to be difficult for tech, for both big, mid, and small cap tech. I think that the back half of the year is going to be a great year and into 2024. And the substance of it is I still believe that even with a rate pause, the key factor here is employment, unemployment. That still has been stubborn. Historically, that's the stickiest part of inflation. And all these gyrations within the banks and what we've seen across the liquidity and in the money system, I think ultimately plays into what is the inflation question. I think that still is going to be where investors are going to resolve their debate about what's going to happen with stocks. And again, I think that inflation question is largely dependent upon hiring. And so I'm sticking with this view. I wish there was more optimism. I'm glad to hear about some of the potential pauses and rate hikes, but I think that in terms of invest in tech stocks in the near term, it's a little bit of a head fake. Again, all you need to do is keep an eye on that unemployment number. We need, unfortunately, to see that number inch higher to really take pressure off inflation and ultimately get to a point where investors can sleep well at night knowing that rates aren't going to spike higher in the future.
Right. And in the meantime, consumers are being really impacted by high inflation, Gene. So I want to deal with some of the more recent news on some of the stocks that you follow so closely. Foxconn, for instance, warning about consumer electronics demand this year. How much do you impute that onto Apple at this point?
Well, it's something that should be absolutely considered. I also would look at how Apple is thinking about their spending with partners like Foxconn and some of the other suppliers. A few weeks ago, Apple came out in one of their filings and said that they're going to increase spending with component suppliers this year by 16%. I think about that when I hear the Foxconn news. And what that means is that they're spending more with their component suppliers. Some of that may be increased in component costs. Unlikely, given their margin guidance is for higher for the March quarter, surprisingly higher. I think what it means is Apple is still doing probably the best job of any of big tech in terms of navigating the storm. Again, the street's looking for 1% growth this year. I suspect that they're going to comfortably beat that, despite what we're hearing from Foxconn. No company is immune, but I think Apple is probably the safest place to be when it comes to kind of navigating at least these next 6 months.
The other piece of the Foxconn warning that came out overnight, Gene, is that they are seeing good business, good demand from cloud, from networking, from components. And so how do you then, think about the stocks that you follow and who will benefit from that?
Well, I think, that companies like NVIDIA potentially could benefit from the cloud side. I think you can even see some benefit from a company like Intel, which has struggled a lot recently. But so I think that's an important distinction, is that Foxconn is a bellwether. You need to read between the lines and around the lines in the case of you need to look at some of the filings with Apple. And I think there are going to be some points of some bright spots. Again, big picture doesn't change. Next 6 months is going to be difficult for tech, but I think back half the year is setting up well.